your guide to Australian property. Now we'll discuss mortgages. So, what is a mortgage? A mortgage, otherwise termed home loan, is a loan taken out when you purchase property or land. Notably, there are differences between home loan types. Most people get as what's called a principal and interest home loan, as opposed to interest-only loans, as this allows you to pay off the entire amount plus interest accrued on your mortgage. Interest-only mortgages, by comparison, only allow you to pay off the interest, not the principal loan. The home loan application process can be quite lengthy, but generally not too complicated. It will usually involve the following steps. Firstly, gather your required documents. Then, compare home loan providers. You'll then need to get a preliminary assessment by the lender, followed by submission of your application to the lender. The lender then completes a property valuation and will then approve or reject the loan. The lender sends you an offer. And lastly, the loan is settled and the funds are advanced to you. Some people get a mortgage pre-approval. Home loan pre-approval loans. Home loan pre-approval approves you to borrow up to a certain amount, giving you a good idea of what you can and can't afford. The documents needed for a home loan pre-approval include proof of income, for example, pay slips, tax returns, etc. Bank statements and proof of savings. A list of your current assets and liabilities, for example, credit card and personal loan debts. And 100 points of identification. You can use your driver's license, passport, Medicare card, etc. You should note, however, that getting pre-approved doesn't guarantee your home loan application will be successful. A mortgage has a number of different components, which we'll discuss now. Firstly, collateral. When you have a mortgage, you have legally committed to repaying the loan, plus interest and other costs by the end of the loan term, which is usually between 20 to 30 years. The property you have bought is classed as collateral for the mortgage because real estate generally goes up in value, so it's a relatively safe bet that the lender will be able to recoup its money either when you sell the property, pay it off, or the lender sells it. In the world of finance, principal is a vitally important part of the equation because it is the sum of money that you borrowed to buy the property in the first place. The principal is the amount that you've agreed to pay back, plus interest over the life of the loan, or sooner in some cases. Interest is the fee that you have to pay to borrow the funds, which is usually percentage interest rate. For example, if you borrow $500,000 at an interest rate of 5% per annum, $25,000 of your repayments in the first year will be interest charges based on the principal amount. As your principal reduces, the interest you pay will also reduce, so you'll pay more of the loan. It's important to understand that interest rates do change depending on various economic conditions. Plus, with most mortgages being 20 to 30 years in length, you are likely to experience periods of low and high interest rates. Lenders require some sort of deposit before they will approve a mortgage on a property purchase. While this figure does change depending on financial conditions, it generally is between 5 to 20% of the purchase price. The deposit can be from cash savings, but it can also be drawn from equity in another property. If the deposit is less than 20%, you will generally have to pay lenders' mortgage insurance, which is a policy that protects lenders against borrowers who default on their home loans. This fee does vary depending on how much deposit you have, as well as the state or territory where the property is located, but it can be useful for first home buyers as it helps them get into the market much sooner than they could if they tried to save a 20% deposit. Lenders' mortgage insurance can also generally be capitalized or added onto your mortgage too. Paying off a mortgage is usually the goal. At the end of the day, there are only two ways to pay off a mortgage. One is to pay off the principal and interest components over time, which can be the life of the loan or more quickly if you make extra repayments. The other, of course, is by selling the asset at some point in time. Whichever strategy is the right one for you, you will eventually have to reduce the debt on your loan to pay the lender back its money. So which type of mortgage is best for you? There are a number of different mortgages available these days, with specialized products for different types of buyers. Some of the most common home loans include standard variable rate home loans. Standard variable rate loans are Australia's most popular type of home loan. The interest rate varies throughout the loan term. These loans generally offer excellent flexibility, low fees, and often offer features such as an offset facility, redraw facility, no limits on additional repayments, and in most cases, no early payout penalties. Then there's the basic variable rate home loan. This loan typically offers lower interest rates but fewer features than a standard variable loan. You often have the option to pay for any additional feature required. As it is a variable loan, interest rates and repayments will vary throughout the loan term as rates change either up or down. Then there's the fixed interest loan. Under a fixed interest rate loan, the interest rate is fixed for a specified period, usually between 1 and 5 years. This loan gives you the certainty of knowing exactly what your monthly repayments will be, as well as peace of mind, knowing the repayments won't rise. However, the downside is that you won't benefit if rates go down during the fixed term period. There's also split loans. This type of loan combines the security of a fixed rate home loan and the benefits of a variable loan. A split loan allows you the freedom to choose how much money you assign to each loan. Common split loan ratios are 50-50, 70-30, or 60-40, with one portion fixed and the other portion variable. Another option is a line of credit. A line of credit loan provides you with access to the equity in your home or investment properties up to a pre-approved limit. You access the funds as you need to, plus the interest rate on a line of credit loan is usually a variable rate and repayments are interest only. Lastly, there's an offset loan. A 100% offset loan is very similar to an all-in-one loan. Rather than putting all your salary and other income into your loan, it goes into an offset account that is directly linked to your home loan. Any balance in the offset account is 100% offset against your home loan. This reduces the amount of interest you have to repay, making your money work harder for you. What are the issues to consider? Are you ready for the responsibility? At the outset, mortgages can seem a bit scary because they are a commitment of 20 to 30 years. However, mortgages are a vehicle to improve your financial position by investing in assets that generally grow in value over time, while the principal you borrowed stays the same. For example, if you bought a house for $600,000 and borrowed $500,000 from a lender, and after 20 years, the property has increased in value to $1.3 million, but your mortgage has reduced to just $150,000 because you've been making principal and interest repayments, then that means you have equity in the property of $1.15 million. That is the power of using the bank's money to improve your financial position. Before you apply for a mortgage though, it's a good idea to consider the following questions. Firstly, can you comfortably make the monthly mortgage repayments, especially if interest rates increase? Are you confident that your financial status, that is, your job, health, family situation, etc., will not adversely impact your financial responsibilities over time? Can you manage any resultant changes to your lifestyle if required? And are you aware of the legal impacts of being unable to continue to finance the loan? That's an overview of Australian property, including purchases and sales of property, the tax implications, and the associated costs of owning property in Australia. We hope you found this useful in better understanding the processes involved in owning property in Australia and how you can utilise property for investment purposes. Please let us know if you have any questions. We'd be happy to advise and assist you if you're considering buying or selling your property in Australia. Bye for now.